The IRS has a trap buried inside the American tax code that the overwhelming majority of married couples have never been warned about. It does not activate when you retire, it does not activate when the stock market crashes or when Congress passes a new tax bill. It activates the day your spouse dies. And the surviving spouse, in almost every case, walks directly into it while she is still sitting in the funeral home parking lot trying to figure out how to cancel the joint checking account. I call it the widow's penalty. And before this video is over, I'm going to show you exactly how it works, who built it, why Congress has chosen to keep it in place for over 4 decades, and the 4 specific assets you need to move right now while both of you are still alive. Because once the funeral is over, every single option I am about to describe disappears. Her name is Linda. She is 68 years old. She lives in suburban Tampa in a house that is paid off. Her husband Robert died 9 weeks ago, a heart attack in the garage on a Saturday morning while he was changing the oil on the Buick. Robert and Linda did everything the financial advice industry told them to do. They paid off the house early. They maxed the 401k for 30 years. They drove their cars until the wheels fell off. They never carried a credit card balance. By every objective measure, this couple was the model American middle-class retirement success story. Last year, 2025, Robert and Linda filed married filing jointly. Their combined income was $116,400. Robert's Social Security check was $3,100 a month. Linda's was $1,900. His company pension paid $18,000 a year. Their traditional IRA, mostly Robert's old 401k rollover, had a balance of $740,000 and threw off a required minimum distribution of $28,000. Their Schwab brokerage account generated $6,000 in qualified dividends. 3 CDs at the local credit union paid $4,400 in interest. Total gross income, $116,400. After the standard deduction, the age 65 add-on, and the senior bonus created by the new tax legislation, taxable income of roughly $77,000. Federal tax bill, approximately $8,400. Effective rate, about 7%. For a household generating $116,000 a year, that is an extraordinarily low tax burden. That is the reward for being married under the current tax code. Robert died in January 2026. Linda's income for 2026 dropped immediately. She lost Robert's $3,100 monthly Social Security check, the larger of the two, and now only receives her own $1,900 per month, which comes to $22,800 per year. Robert's company pension had a 50% survivor benefit written into it, so the $18,000 dropped to $9,000. The traditional IRA balance sat at roughly $720,000 by year end. Her RMD as the surviving spouse came in at $27,500. The brokerage still paid $6,000 in dividends. The CDs still paid $4,400 in interest. Total gross income in 2026, $84,100. Linda's income dropped by $32,000. She is materially poorer than she was when Robert was alive. Her federal tax bill in 2026, over $73,000. That number is not a typo. That is not a penalty assessed for fraud or evasion. That is the standard, legal, mathematically correct outcome of the United States tax code applied to a 68-year-old widow in Tampa who did absolutely nothing wrong. Her income went down by $32,000, and her tax bill increased by more than $64,000 in a single calendar year. That is the widow's penalty. And the reason it happens is not complicated once you see the machinery underneath it. The machinery has 3 distinct traps. They fire in sequence. Most CPAs only ever see the first one. The second one catches people who think they are being smart. The third one quietly bleeds the surviving spouse for the rest of her life, and she never connects it back to the year her husband died. Trap 1 is the bracket collapse. The entire structure of the federal income tax bracket system is architecturally built around the assumption of 2 incomes and 2 filers. The 12% bracket for a married filing jointly couple in 2026 stretches from roughly $23,200 all the way to $94,300. That is over $71,000 of income taxed at a maximum of 12%. The same 12% bracket for a single filer ends at $47,150. The married filing jointly bracket is almost exactly twice as wide at every single level up the income ladder. Now understand what happens when Robert dies. Linda does not get to keep the married filing jointly status. The IRS determines your filing status as of December 31st of the tax year. Robert died in January. Linda is single for the entire 2026 tax year. There is a provision in the code called qualifying surviving spouse that extends married filing jointly rates, but only if you have a dependent child living in the home. Linda's children are 41 and 38. They have their own mortgages. Linda gets 0 grace period. She files single. Her bracket just got cut in half. Every dollar she earns above $47,150 of taxable income now faces a 22% rate instead of the 12% rate that same dollar faced 12 months ago. That is not a marginal difference. That is the bracket collapsing underneath her feet. But the bracket collapse is just the opening act. Trap 2 is what I call the RMD Crossfire. Here is where people think they can outsmart the system. They say, fine, I will just spend less. The IRS can only tax money I actually take out of the IRA. Wrong. The required minimum distribution does not care what you need. The RMD does not care that you are grieving. The RMD does not care that Linda's grocery bill and property tax add up to $22,000 a year, and she does not need another dollar beyond that. The IRS runs a calculation every January using something called the Uniform Lifetime Table, a mortality-based schedule, and forces a percentage of the entire traditional IRA balance out into taxable income, whether the account holder spends it or stuffs it under the mattress. At age 73, the divisor on that table is roughly 26.5, meaning you must pull out approximately 3.8% of the balance. By age 75, the divisor drops further. By age 80, you are pulling out nearly 5% of the entire balance every single year. By age 85, the mandatory withdrawal rate approaches 7%. The IRS is designed to drain the account completely over the statistical remaining lifespan of the account holder and to collect taxes on every dollar on the way out. While Robert was alive and the couple filed jointly, those forced withdrawals landed in the wide married bracket and faced a blended rate around 12%. Now Linda is a single filer. Every dollar of RMD income lands in her narrowed single bracket. The same $27,500 RMD that cost the couple roughly $3,300 in federal tax last year now costs Linda over $6,000. Same money, same account, same IRS, double the rate. That is the crossfire. The forced withdrawal mechanism combined with the narrowed bracket creates a compounding annual tax extraction that continues every year for the rest of Linda's life. But even that is not the most insidious trap in this sequence. Trap 3 is the IRMAA time bomb. Most people have never heard of IRMAA, the income-related monthly adjustment amount. It is a Medicare premium surcharge that the federal government layers on top of your standard Part B and Part D premiums based on your income from 2 years prior. And it operates on a single filer threshold that is exactly half the married couple threshold, by design. While Robert was alive, the couple's joint modified adjusted gross income kept them comfortably under the married IRMAA threshold of approximately $212,000. They paid the standard Medicare Part B premium of around $185 a month. After Robert dies, Linda is now measured against the single filer IRMAA threshold, which begins triggering at a significantly lower income level. Her MAGI, which now includes the full RMD and 85% of her Social Security as taxable income, pushes her into the first IRMAA bracket. Her Part B premium jumps from $185 to approximately $260 a month. Her Part D drug plan absorbs an additional surcharge of roughly $13 per month. That is nearly $900 a year in additional Medicare costs, every year, recurring, for the rest of her life, because she had the misfortune of being widowed. And here is the piece that makes this trap particularly vicious. There is a 2-year look-back built into the IRMAA calculation. Your 2026 income determines your 2028 Medicare premiums. So if Linda does a Roth conversion in 2026, which is actually the right move strategically, and that conversion spikes her income above the next IRMAA threshold, she will not feel the penalty until her Medicare bill in 2028. By then, she has no memory of what triggered it. The delay is not accidental. The delay is engineering. Now I want you to stop for a moment. If you are watching this video and you are married, I want you to go to the comment section right now and answer one question honestly. Have you and your spouse ever sat down and modeled what your taxes look like the year after one of you dies? Not your estate, not your will, your annual tax bill, the year after. I am betting that 95% of you watching this have never done that calculation. Not because you are irresponsible, because nobody told you to. Your broker never brought it up. Your banker never brought it up. Your financial planner never ran that scenario. Drop your situation in the comments, your ages, roughly what is in the traditional IRA, what the pension survivor benefit looks like. We are going to work through this together. I read every single one. This is Recession Mornings, and we are just getting started. Before I show you the 4 assets you need to move, I want to name who built this machine and why it has stayed intact for over 40 years, despite being one of the most widely documented forms of financial injustice in the American tax code. Congress has known about the widow's penalty since the 1980s. There are white papers. There are think tank analyses from across the political spectrum. The Joint Committee on Taxation has had this data for decades. Multiple sessions of Congress have had the explicit opportunity to fix the bracket disparity and chosen not to. The reason is not ignorance. The reason is revenue. There are approximately 800,000 new widows and widowers in the United States every year. The average 65-plus widow carries a traditional IRA balance somewhere between $250,000 and $1.5 million. The marginal tax rate jump from the bracket collapse alone, multiplied across that population every year, generates billions of dollars in incremental federal revenue that does not require a single new tax law, a single floor vote, or a single press conference. It is automatic. It is invisible. It targets people who are grieving, isolated, and statistically unlikely to organize or fight back. Congress calls it revenue. I call it what it is. Now let us talk about the 4 assets. Because everything I have described so far, the bracket collapse, the RMD Crossfire, the IRMAA time bomb, is not a sentence. It is a condition. And conditions can be treated, but only before the triggering event, only while both spouses are alive, only while you still have access to the married filing jointly brackets, the wider conversion runway, and the legal tools that the tax code does allow, tools that CPAs consistently fail to deploy because they are reactive by nature, and this problem requires proactive action years in advance. Asset number 1 is the traditional IRA, or the traditional 401k, the SEP IRA, or any pre-tax retirement account carrying a meaningful balance. This is the single largest source of widow's penalty damage in the typical American retirement portfolio. Every dollar sitting in a traditional pre-tax account is a dollar of future ordinary income that the IRS has not yet collected on. The account has been growing tax-deferred, which feels like a gift until you understand that the IRS is a silent partner in that account and they get to name the tax rate at the time of withdrawal. While you were accumulating, that felt like a good deal. In retirement, when the RMDs begin, it starts to feel different. When one spouse dies and the survivor faces the narrowed single bracket, it becomes a financial emergency. The strategic response is Roth conversion, aggressive, multi-year, planned Roth conversion, executed while both spouses are alive and filing jointly. This is the most important single tax move in the entire pre-death planning playbook, and it is chronically underused because it requires paying tax today to avoid paying more tax later. And most people, and most financial planners, resist paying taxes today, regardless of the math. Here's why the math wins. While you are married and filing jointly, the 22% bracket in 2026 runs from roughly $94,300 all the way up to $201,050 of taxable income. That is over $100,000 of conversion runway at 22%. A rate that looks very reasonable compared to the 32% and above brackets that a surviving spouse on a large IRA will eventually face. You can convert $80,000, $100,000, even $120,000 from traditional to Roth in a single tax year. You pay the tax now. That money converts into a Roth account. It grows permanently tax-free. It has no required minimum distributions, ever. And critically, when one spouse dies, the surviving spouse inherits the Roth IRA with 0 taxable income generated on withdrawals. None. The Roth distribution does not count toward modified adjusted gross income. It does not push more Social Security into the taxable column. It does not trigger IRMAA. It is clean money. Run the actual math against Linda's situation. She has $720,000 in a traditional IRA at age 68. If she does nothing, if Robert had never converted, her surviving spouse will pull $27,000 to $45,000 per year out of that account under the RMD schedule, every year, at the single filer rate, with the compounding IRMAA exposure, for potentially 20 years. The total federal tax paid on that account over Linda's remaining lifetime under the do-nothing scenario. Conservatively, $180,000 to $240,000 in tax on money Robert already paid Social Security and Medicare taxes on while he was earning it. The alternative: Robert and Linda had 6 years of married filing jointly ahead of them before he died. If they had converted $100,000 per year over those 6 years, staying inside the 22% and 24% brackets, they would have paid roughly $132,000 to $168,000 in total conversion taxes over that period. The Roth grows, Linda inherits it. no RMDs, no IRMAA trigger, no single bracket exposure. The same tax liability, roughly the same dollar amount, but front-loaded into the years when the brackets were wide and permanently eliminated from the years when they would be narrow. That is the entire game. Converting a recurring multi-decade tax liability into a one-time front-loaded tax payment made in the most favorable bracket environment you will ever have access to. If you are under 73 and have not yet started RMDs, and you are married, every year you delay this conversation is a year of conversion runway you cannot get back. Asset number 2 is the taxable brokerage account. This is the asset where most CPAs give precisely the wrong advice. The standard recommendation, donate appreciated stock during your lifetime, gift it to reduce the estate, harvest the gains gradually, is sound advice in isolation. In the context of a married couple where one spouse may die first, it can be a six-figure mistake. Here is the tool that makes the brokerage account a weapon rather than a liability. Internal Revenue Code Section 1014, the step-up in basis at death. When a spouse dies and leaves appreciated assets to the surviving spouse, the cost basis of those assets resets to the fair market value on the date of death. The embedded capital gain, the appreciation that occurred over years or decades of holding, is legally forgiven by the federal government. It disappears. The surviving spouse can sell the asset the following morning and owe zero in capital gains taxes. Make this concrete. Robert bought $100,000 of a broad index fund in 2005. By the time he dies in January 2026, that position is worth $310,000. Under normal circumstances, if Linda sold those shares, she would owe capital gains taxes on the $210,000 of appreciation. Instead, because she inherited the position at Robert's death, her new cost basis is $310,000, the fair market value on the date of death. She sells the following week. Her capital gains tax bill, zero. The $210,000 gain was erased entirely by the step-up. But the step-up only works if the asset is owned correctly at the time of death. This is where titling becomes critical. In a community property state, California, Texas, Arizona, Nevada, Washington, Idaho, Louisiana, New Mexico, Wisconsin, jointly held community property typically receives a 100% step-up on both halves of the account when one spouse dies. Both the decedent's half and the survivor's half reset to fair market value. That is the most favorable possible outcome. In a non-community property state, Florida, Ohio, New York, Georgia, and most of the eastern seaboard, joint tenancy with rights of survivorship typically only steps up the decedent's 50% share. The surviving spouse's original 50% retains the old cost basis. Linda inherits the account, but only half of the embedded gain is forgiven. The strategic fix depends on your state. In a community property state, confirm your brokerage account is titled as community property with rights of survivorship, not simply as joint tenants. In a non-community property state, a joint revocable trust with specific community property language drafted by an estate planning attorney can in some circumstances replicate the community property step-up. This is not a do-it-yourself exercise. The wrong titling on a brokerage account with $300,000 of embedded appreciation costs the surviving spouse somewhere between $30,000 and $60,000 in unnecessary capital gains taxes on a single transaction. Get a real estate planning attorney, not a generic CFP, not a branch banker, to review the titling on every taxable account you hold. Asset number 3 is the pension survivor benefit. This is the silent killer in the retirement income picture, and it operates in a way that most couples never fully examine because the decision point passes at the moment of retirement and almost never gets revisited. When a defined benefit pension holder retires, they are typically presented with two primary payout options. Option 1, single life annuity. This pays the highest possible monthly check for as long as the retiree is alive. When the retiree dies, payments stop entirely. The surviving spouse receives nothing. Option 2, joint and survivor annuity. This pays a lower monthly check but continues paying, usually at 50%, 75%, or 100% of the original amount, to the surviving spouse for the rest of her life. The math on this decision is deceptively simple on the surface and devastatingly complex underneath. The retiree looks at the two numbers, $3,400 a month for single life versus $2,800 a month for 100% joint and survivor. The $600 monthly difference feels significant. They take the higher check with a plan to self-insure using the IRA. The problem is that the self-insurance plan almost never accounts for the widow's penalty on those IRA withdrawals. The $600 per month they saved by taking single life is consumed multiple times over by the tax cost of the extra IRA distributions the survivor must now take to replace the lost pension income. If you are pre-retirement and a pension is part of your income picture, the directive is simple. Elect the highest survivor benefit option you can afford, even if it materially reduces your monthly check during your joint lifetime. Model the comparison not just on monthly cash flow, but on the total after-tax household income in the years after the first death. The pension survivor benefit is tax inefficient in isolation. It is ordinary income, but it is far less damaging than the combination of lost pension income plus increased IRA distributions plus the bracket collapse plus the IRMAA spike. If you are already retired and already receiving a single life pension, the conversation shifts. Pension maximization strategies using life insurance exist, where the retiree takes the higher single life payout and purchases a life insurance policy on themselves to replace the pension income for the surviving spouse. Whether this pencils out mathematically depends heavily on the retiree's health, insurability, current premium costs, and the size of the pension differential. This is a legitimate strategy in specific circumstances. It is not a universal solution. Run the numbers with an independent fee-only advisor, not someone who earns a commission on the life insurance policy they are recommending. Asset number 4 is Social Security claiming strategy. Of all 4 assets, this is the one with the longest lead time and the one most couples permanently mishandle because they make the claiming decision based on break-even analysis rather than survivor optimization. The standard Social Security break-even calculation asks, at what age does delaying benefits pay off compared to claiming early? If you claim at 62 versus 67, the break-even is somewhere around age 79 or 80. Most Americans do not reach 80. Therefore, the math seems to favor claiming early. This logic is incomplete, and in a two-spouse household, it is actively dangerous. Here is the correct frame. In a married household, Social Security is not just a retirement income stream. It is a longevity insurance policy for the surviving spouse. When one spouse dies, the survivor keeps whichever benefit is larger and loses whichever benefit is smaller. The higher earner's benefit, especially if maximized by delaying to age 70, becomes the permanent lifetime income floor for whoever lives longer. The lower earner's benefit disappears entirely. This means the highest earner in the household should almost always delay Social Security to age 70. Every year of delay between full retirement age and 70 increases the benefit by 8%, guaranteed, inflation-adjusted, for life. If Robert claims at 70 instead of 67, his benefit might be $3,800 per month instead of $2,900. When Robert dies, Linda keeps $3,800 per month instead of $2,900 per month for the rest of her life. The difference is $900 a month. Over a 15-year widowhood, that is $162,000 in additional lifetime income that is also partially tax-shielded, inflation-adjusted, and not subject to IRMAA. The lower earner, Linda, can claim earlier to provide household cash flow while the higher earner delays. This is called the split claiming strategy, and it is the single most underutilized optimization in the entire retirement planning toolkit. The widow's penalty is not inevitable. Every trap I have described tonight has a countermove. The bracket collapse is countered by Roth conversions in the married filing jointly years. The RMD Crossfire is countered by reducing the pre-tax account balance before the RMDs become mandatory. The IRMAA time bomb is countered by keeping Magi below the single filer thresholds through Roth distributions rather than traditional IRA withdrawals. The pension trap is countered by electing the right survivor benefit before the retirement papers are signed. The Social Security optimization is countered by the split claiming strategy that maximizes the survivor's lifetime income floor. None of these moves are available after the funeral. Linda is sitting at her kitchen table in suburban Tampa with a legal pad and a letter from her CPA. The $73,000 tax bill is not reversible. The window for Roth conversions in the wide married bracket closed in January when Robert died. The pension survivor benefit election was locked in the day Robert retired. The Social Security claiming decision cannot be undone. Linda is working with the hand she was dealt. But you are not Linda yet. If you are watching this video, you still have time. The question is whether you use it. Send this video to the married couple in your life who has a traditional IRA with a meaningful balance. Not next week, tonight. The cost of one conversation before the funeral is $0. The cost of not having it is 6 figures, and it lands on the person already sitting alone at the kitchen table. This is recession warnings. Do the math before the IRS does it for you.